Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of October 5th, 2025. And in this week's episode, it's just myself, sprocket888. And I'm going to take a look at a couple of recent trades and a couple of upcoming trades to give some status updates on how they went and how they're going to go. The two trades that I've completed recently is CCL or Carnival Cruise Lines and NKE or Nike. And then the two that I've recently put on that will conclude this week that this episode is airing is STZ Constellation Brands and DAL Delta Airlines. So in this week's episode, we're going to dive into those. I'm going to show you what my P&L profit target looked like. I'm going to show how some of those panned out. And I'm going to show you what the charts look like and what they did look like and see if we can see what might happen on the upcoming trades. Also down below, you'll find a link to our Discord where you can hop in there, say hello to Viper, myself, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. Also, you'll find a link to thetagang.com/sprocket888 where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know, and we will get it there. But let's hop to this week's episode. In this week's episode, like I mentioned, we're going to do a quick update on two trades that have completely finished and do a reflection back on them. And then I'm going to touch on two trades that are just opened, they have not closed, and see the trajectory and see what I was thinking when it comes to those trades. Now, all four trades are actually earnings trades. This is the absolute very tail end of the earnings season. Then we're going to kind of go through a little bit of a lull period. We're kind of in it now. There's really only a handful of stocks that are hitting my earnings trigger each week. And then the next quarter earnings are really going to start to take off here in about another week or two, usually starting off with the financials and the banks. But I was able to find a few different earnings trades, not huge ones that I love to play, but they were good enough that they did meet into my screener. And so that's what I kind of want to reflect on a little bit today. So the first two that we'll talk about, and what we'll do is we'll talk about the P&L charts first of CCL or Carnival Cruise Lines and then NKE Nike. So we'll take a look at the two profit and loss tables of when I purchased, when I sold, when I closed, and then we're going to loop and take a look at both the charts for those and see how those charts lined up with my famous Flappy Bird chart. So first up is Carnival Cruise Lines. And this is the table. It was a real brief trade. So both full disclosure, both these first two trades I put on were exactly textbook of what I like to play, where you're putting them on, you're taking them off, and you're done within a week. And so looking at upcoming earnings for this week that I had traded, Carnival Cruise Lines was one of the ones that had earnings. They had very, very elevated volatility. I kind of looked at the price action, looked at the chart, and I did decide to play this as a strangle. What that means is I'm looking for neutral price movement. I'm selling a put and I'm selling a call. So I'm playing both sides of where could those earnings go, saying I don't think it's going to go higher than this, and I also don't think it's going to go lower than this. So those numbers were 28 on the downside and 33 on the upside. And I was able to sell those contracts for 76 cents for both the put and the call together. And then based on my position sizing of targeting about $5,000 to $5,500 in buying power, that equated to 15 contracts. And so that's how I kind of size it. The first thing I do is I look at the elevated volatility to figure out if it's something that I want to play. I pick the strikes. I see how much buying power that's going to take. And then I just put in a multiplier until I reach the buying power of the position size that I desire to have. So in this case, that was 15 contracts at 76 cents a piece. That equated to $1,140 in premium that I collected, effectively putting return on capital, not risk, the return on capital at about 19%. Now it was a little marginally higher, but I closed it out. So what happened? Earnings came out. It really traded a lot lower, and it kind of pushed real close to the strike at first. So I didn't actually close it out the very next day. I waited a little bit to see how it was going to kind of react to burn off a little more theta, because what happened is as you really approached your strike, the premium in that option, while it did go up, It also dramatically collapsed from the volatility, which effectively kept it close to where I purchased it. So the call side was pretty much full profit after the earnings announcement, but they went down on earnings, and so the put side really didn't lose much value. So I had to wait a few days to see how that was going to go. And I was able to finally then close it out for 7 cents. Now, I only closed out the put side. I left the call side open. Now, part of that was more of this was the day before expiration. The chances, in my opinion, of it rallying past that call side were uber small. And some of the fill price when you're that far out of the money on something that people just don't want to trade is not so great. And so I just decided to save myself some of those fees, some of that hassle, and maybe a poor fill price, and just let the call side expire worthless. And focused on the put side because I could get a better fill. There's more trading around it. It was closer to the money. So that's what I did. I was able to close it out for 7 cents, all 15 of those puts. That would keep me from getting assigned those shares. That equated to about $105 cost to close those out. So you subtract that from the credit, and I netted about $1,035. And like I said, the buying power is about 5,500, which gave me about a 19% return on capital when it comes to Carnival Cruise Lines. So in a minute, I'll go to the chart of both Carnival Cruise Lines and Nike. But before I do that, I want to go ahead and go to the P&L chart of Nike. Now, Nike is very similar. Again, they had earnings coming up, very elevated in their volatility. And I wanted to basically play that elevated volatility. However, looking at the chart, it really looked like Nike was potentially kind of starting to rebound. It looked like they might have reached their bottom, and they were kind of on the beginning upswing of that. And so when I see that in the chart from a price action perspective, I get a little bit nervous when it's so far oversold to sell calls, because you can get a big push to the upside. And I kind of balance that with the risk to reward ratio. So I'll look at how much can I collect from a strangle at about a 16 delta. So remember, that's typically where I do my strikes of option strangles. And if I'm going to play directional, I will kind of bump that delta up to about a 30 to 35 delta. And so I'll compare the premium of a 35 delta directional trade to a 16 delta directional neutral trade. And in this particular case, what it really was almost a wash in premium between the two. And so because I was slightly more biased to the directional trade based on the price action of the chart, I chose to only play Nike bullish. What that means is I sold only the put going into earnings, and I pulled that up from a 16 delta to a 35 delta because I was playing directional. And usually when I'm doing this is increasing your probability of assignment because, or at least assignment on owning the shares, because you're pulling it up from 16 delta to 35 delta. Now, I would argue your overall assignment risk is similar because when you do a strangle, you're picking up 16 delta risk of assignment on the downside and 16 delta risk on the upside. So you're still looking at about a 32 delta risk of assignment. And so I'd argue the risk is kind of the same. It just depends on whether or not you're going to go short or long. And I was much more comfortable going long on Nike based on to where the chart was at and its recent price action. So what that equated to was I sold each contract for $1.82. And again, I pick my strike, I look at the buying power, and then I ramp up that multiple to match my buying power that I desire. So in this case, that was $5,500, which was about 6 contracts that I traded. So I sold 6 Nike puts, collected $1,092. Now, in Nike case, they did well. Stock went up. The premium just absolutely collapsed, and it was pretty far out of the money. So I didn't bother trying to close Nike because they had reported the day before expiration. So when I'm looking at it the day of expiration, I just let it expire worthless, which means I didn't have to pay anything to buy them back, and I didn't have any fees associated with that transaction. So it cost me $0 to close these out because they expired 100% worthless. So that means I kept every drop of the premium that I sold in the beginning. So this, again, was also a full winner, much like Carnival Cruise Lines. Now let's go ahead and jump over here and take a look at the Flappy Bird chart. And so let's look at Carnival Cruise Lines first. Remember, I played this as a strangle. And so what I've got here on the Flappy Bird chart are two red boxes. These red boxes are start at my strike prices. Now there's a little bit of a buffer. I didn't bother trying to call it out, that you can kind of go into these strike prices and still not lose money. But just for simplicity, I'm going to call them boxed as, hey, this red means I would be losing money on the trade. And anything between those boxes is perfect. It's a winner. It's where I want to see. This is the start of this red box is basically where I put the trade on. This really, really large candle right here. Shortly after that, that was the big earnings announcement. And you can see what happened is it started to charge down. And so right after earnings, it fell. We got a little bit of a rise. So all this is a 4-hour candle. And then it really dropped down here to about 28.86. And that's where I decided, okay, I'm going to hang on to this just a little bit longer, because one of my valid exit plans, or at least management plans, is if I get my strike breached, I will roll this. And so it was okay to see how much closer to that strike does it actually get. Does it actually drop below 28? Because I knew that in the back of my mind, I could always go ahead and roll this forward to collect more premium and give myself more time. I also could wait to see if enough of that volatility came out, enough of that premium came out, I could close it out for a profit. And so that's what I did. I stalled. And sure enough, it started to kind of turn around. We dipped a little bit closer, but by the day before expiration, I was able to close this thing out for that 7 cents, where enough of that stuff kind of fell away. But you can see if I had hung on to it to the very bitter end, it still would have been above my strike, and I could have collected that extra $105 that I paid to close it out. But to me, I had already hit my profit targets. It was still an easy thing to close based on the liquidity in the option. There was still a lot of action around that $28 price, but up here at 33, there really wasn't much, which is why I let that side expire worthless. So yep, that's the Flappy Bird chart for Carnival Cruise Line. So the next one we'll take a look at is Nike. Let me pull up the Nike Flappy Bird chart. And you can see right here now, overall, if you zoom out, Nike is really on a big, massive decline, and it's kind of starting to build back up, which is where I got kind of that little bullish thesis heading into earnings. And so you can see this Flappy Bird chart actually comes pretty close to where this is trading at here at the beginning of the start of the red bar, and that's before earnings. And that's because I was playing the 35 delta. Had this been the 16 delta, we'd have been down much further down here, and we had had a lot more space. So if I flip back to Carnival, you can see how much space there was between, ignore this, so big candles and earnings. You can see how much space there was between the actual price and the strike, actual price and the strike. And that's because that was 16 delta. With Nike, I played it a lot closer to the money because that's the higher delta, but I played it directionally. So on the upside, we could have gone up, and it wouldn't have mattered how far it went up. I had never lost money on an upward move. And that's the difference about shifting the balance to that bullish move. But you can see right here, this big green candle was the earnings. That's where it just kind of rocketed up. Now, it actually fell off the last day going into expiration, but my strike was down here at 67, and where we started was 75. So I was pretty confident and felt pretty good about just leaving that open to go straight into expiration. But you can see that, yep, the bullish trade works out. It stayed 100% above my loss point. So it was all green for those two trades that we put on. Now, let's hop over to the two trades that I have recently put on, but I don't know how they're going to pan out because the earnings have not been announced yet. They're upcoming this week. So by the time you watch this episode, they likely could have already been out. If you happen to watch it soon enough, then it won't have happened yet. But where we're looking at here with Constellation Brands, ticker symbol STZ, this was a elevated volatility going into earnings. So wanted to play this with selling again. But I looked at this one and I felt very similar to the trade that we were at with Nike, where I wanted to play this bullish. Now, the earnings are upcoming this week, but I went ahead and we went with the 35 deltas, so that equated out to the $135 put. Now I priced that out at about $2. Now my position sizing, I couldn't quite get to the 5,500. So I went with 3 contracts because that got me to 5,250. And that, like, you can see that the return on capital here is not as good. That's because this volatility wasn't quite as extended as I like to get when it comes to premiums, but it was right on the edge. So when I told you these were close, but not really 100% there, they were good enough to put on. And given the lack of other options, I went ahead and played this. So I collected $600 from selling those puts. Now, if those end up expiring worthless, or I'm able to close them out for just pennies, we'll be looking at about 11% return. If it gets higher or I end up having to roll or things like that, then that will change. But ideally, this particular trade will be looking at about 11% return on capital. And this brings us to the next one that I looked at. Now, this was Delta Airlines. Now, this was a little bit better than the Constellation Brands. Constellation Brands, I really just liked because of where it was in the price action. Historically, they're very strong. I just think in this economic environment, it's a decent thing to have. They have a lot of the alcoholic beverages, things like that. So in recessions and stuff like that, it's still a staple that people end up spending money on. Overall, it was extremely depressed. So I'm really okay going along those shares, which really played into, let's go ahead and go for it, even though it's not as much premium as I would like to collect. Now, Delta Airlines was a little bit better of a position. And now, to be honest, I was a little bit skeptical on playing Delta Airlines because it's a little bit elevated from a price action standpoint, but it is continuing to climb. And if there is some sort of economic recession, a lot of times the airlines are going to feel that because you get travel contraction, you get business spending contraction, you get a lot of things, and those can really, really hit airlines. So I'm not 100% as solid about going long Delta Airlines, but I'm kind of okay with it. So anyway, I did end up playing this one neutral, which means I put on a put and a call or a strangle, and I went with about a 16 delta of each of those. And that's about a $53 put and a $63 call. Those together, I collected $1.24 for each of those contracts, rolling that up to about a $5,500 buying power size. That was 7 contracts, so I collected $868. So I'm looking at $868 in the perfect ideal case of absolute worthless contraction and no value left in the options, which is about a 16% return on capital. This could shift a little bit depending on where I end up closing out, but going into the earnings week, this is what it looks like. Now let's hop over to the Flappy Bird chart for these, starting off with Constellation Brands or STZ. So again, this is where overall in the chart, I really just feel like this is a potential turning point and a potential area where it really is oversold, and which drew me to go with just the put side sale. So here we are, the current price. This was a 35 delta, decent leg down. Earnings have yet to happen, so we'll see what happens. It's actually this coming Monday, so pretty much the day this video comes out will be earnings. We'll see where this thing goes from there. But basically anything north of where it is, and we're 100% winner, and we can give back a little bit from where we are. So we're about 142. We can give back to about 135, which is where my strike is before things become not as well for me. And I might have to consider rolling or some of the management options. And lastly, Delta Airlines. So we look at Delta. This is where I went with that 16 delta. Gave quite a bit of cushion here on my Flappy Bird chart. I really like kind of the call side because, Delta has kind of been moving on an upward trend. This is really kind of at the ceiling of where there was a reaction back down before. So at least hopefully might get a little bit of a pause if we end up rallying up there. Additionally, if we kind of go lower, we'll just see. But this is where that Flappy Bird chart comes in, and so we got about this much margin of error on the upside and the downside post earnings. So we'll see how that pans out for us on the Delta. And that brings us to the end of this week's episode. Like I said, it was just going to be a quick episode. Wanted to run through 2 trades that I have recently put on and concluded, as well as 2 trades that I have recently put on but have not concluded. Those are my 4 most recent trades. There is nothing hidden there that I have left out from a bad news story. There's many other trades that came before that, but I wanted to just kind of call out, hey, what's going on with the most recent trades? And that's that Carnival Cruise Lines, Nike, Constellation Brands, and Delta Airlines. So really, just more insight into the different price points and decision makings that I take going into these. Hopefully, you have found something interesting. You're starting to drive into a style for your trading. If not, maybe my data points can give you some inspiration, some thought, some more stuff to dig into. So wherever you are in your trading journey, I hope you have good luck upcoming, have fun, and remember, think outside the block.